We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Adrian Day, CEO of Adrian Day Asset Management and manager of Euro-Pacific Gold Fund. Thanks for joining me today, Adrian.
Well, thank you, Tom, for having me back. I appreciate it very much.
I always enjoy our conversations here, Adrian. And, you know, it seems like we always have something interesting to talk about, but there seems to be this kind of lull period, let's say from the investment standpoint. But I'd like to dig in a little bit about let's say that mismatch between expectations and reality. So, you know, given that monetary policy works with very long and variable lags, I've heard you say that it takes 18 to 24 months for the effects of changing monetary policy to be felt in the economy. So considering that the Fed entered its most aggressive rate hiking schedule ever in January of 2020, do you see right now as just the start of the period where we could really start to feel the consequences of those first rate hikes?
Yeah, no, absolutely. And there's an awful lot you've said there to address. I think you said they started tightening in January 2020.
22.
Which of course, which isn't, yeah. So, and in fact, the first rate hike was, I think, in April. So we're only just now at 18 months. The average of the past seven rate hiking cycles, the average is 22 months. So, you know, you mentioned investor expectations, and I think investors generally always expect things that are inevitable to happen sooner than they do. You know, as a species, we're kind of impatient when we know something should happen and when we know something will happen. That's certainly true with the gold price. We'll talk about a little bit later, but it's certainly true of the economy. I mean, when I hear people, you know, smart people, but always politicians or academics, not business owners, politicians and academics talk about it's not only a soft landing now, they're talking about no landing. This is just preposterous. And it flies in the face of reality. It flies in the face of what is happening to people right now, but it also flies in the face of history. As I've said many times, there's always these long lags. And so if you say, and what's most important, of course, is when interest rates go positive. And that only happened in June by a very small amount. So we've only been positive for a few months. But the first interest rate was exactly 18 months ago. First interest rate hike was 18 months ago. And again, the economy works with these long lags. I think, I mean, I've said all year, but I'm expecting a recession to start at the end of this year, at the turn of this year, the end of this year, beginning of next year. Mm-hmm. And I think we're on track for that, frankly.
So, Adrian, you know, all that being considered, this talk about the soft landing, I've heard you say that you're not expecting a market crash, but more so a slower rotation of liquidity within these sectors. So, you know, do you still not expect an actual market crash?
Yeah, it depends obviously how you define a market crash. I'm not expecting a crash, but typically when you see a market crash, they're unexpected. So, you know, I may be wrong on that. But the reason I'm saying that I'm not expecting a crash is because when you look at market valuations, and the S&P today, the average valuation is, say, almost 20 times earnings multiple, and you could look at other valuation metrics, we're certainly well above the historical average and much closer to the top. We're not at dot-com bubble levels. But it's important to realize that those high valuations are really centered on a handful of stocks. And so for most stocks in the S&P, if you look at 493 stocks out of the S&P 500, they're up about 4% this year. So, and the valuations on many of those are a lot more reasonable. And that's why I'm saying I don't expect a crash. We may see a crash in things like NVIDIA, just to name one, but I don't think we're going to see a broad market crash. And so as the market, as the high-tech leaders come down, I would expect some of that money to go back into the market, into things like oil stocks, commodity stocks generally, and value stocks generally.
So, Adrian, what data are we seeing that points to these lags being the case as the economy is on a more negative trajectory now than over the past 18 months?
Yeah, I mean, you can look at a lot of things. You can look at, the most important things are the consumer. So people look at consumer spending and think the consumer must be doing okay. But the increase in consumer spending this year, first of all, is less than this increase in CPI. That means that means consumers are actually buying less in terms of either quantity or quality. You know, they're going down from high-end products to lower-end products to store brands and so on. People, the Walmart CEO made a point that they're seeing a lot of new customers in their stores, people that have not been in their stores before. So people are downgrading, but also clearly, if prices are up by 5% and consumer spending is up by 3%, that means that you are spending less. And I mean, I think prices in the stores are up more than 5%, but so you're spending less. It was true last year, it's true this year. And so what's happening now, we're seeing as consumers have run down at the bottom 80%, basically, not even the bottom 50%, the bottom 80%, as they have spent all of their COVID lockdown savings. That's all gone now, completely gone. We're not just talking about savings rate declining, we're talking about savings in absolute levels. All that was built up in 2020 and 2021 has gone. We're seeing now consumers increase spending on credit cards and not paying up the balances. So the balances on credit cards are much higher than they were. And now this year we're starting to see credit card defaults shoot up. At first it was Capital One, which tends to serve, and some of the store cards like Macy's, Capital One, Macy's, they tend to serve the lower half of the population in terms of net income. But also recently, American Express said that their credit card defaults had gone up by about 30% over a year ago. So this is hurting all segments of the economy, particularly, of course, the lower income, but it's hurting all segments. And so as you see credit card balances go up, then you see credit card defaults. I mean, this is a clear indication that we are heading very, very close to a recession. One other point I'll make, people talk about employment. Well, the unemployment rate's low. Well, we can talk about a lot of specifics with that, like the labor participation rate being very low. So there's a lot of people in the working age group who simply have stopped looking for jobs or no longer qualify for unemployment, and so they no longer show up in the unemployment rate. But all of those things are, and there's a lot of people with part-time jobs who really want full-time jobs, and even more so are there white-collar workers who can't find the kind of job that they're qualified for and that they've always had, but they're employed because they're taking a job in a restaurant, you know, to earn some money to support their family. But they're certainly employed, but they're what we might call,
maybe underemployed.
Yeah. Underemployed. Thank you. I was searching for that. Underemployed. But given all of that, notwithstanding all of that, yes, the unemployment rate is low, but people forget the unemployment rate moves up once a recession has started. People are saying, well, employment's good, so we're not going to have a recession. Just look at history. The unemployment rate has always been the lowest immediately before the recession starts. So I think all of the indications, you look at manufacturing, you look at all sorts of indicators, they're all pointing to a slowing economy. as well as the technical indicators, like the leading economic indicators and the inverted yield curve, for example. So, and again, people say, "Oh, the yield curve inverted a year ago. We haven't had a recession. This time it's different." Again, just look at history. It takes a year after the yield curve inverts before you move into a recession. There's nothing unusual about this time.
Mm-hmm. Adrian, you mentioned let's say the amount of savings that the consumer had coming into this time because of COVID, because of, let's say, the size of the monetary stimulus that was pushed out, monetary and fiscal stimulus that was pushed out.
Yeah.
Because of that, let's say, the magnitude of that stimulus and, let's say, the length of the last bull market, does this add to the lag time that it takes for the markets to correct and the consumer to correct as well?
No, absolutely. Good point. And I've said this before. Yes, but the runway, if you like, is so much longer now because we had excessively easy, excessively loose monetary policy for so long. And I'm not just talking about the 2020 stimulus, 2020-21 COVID stimulus, but I mean, we've had excessively easy money for so long. Look at interest rates, for example. From 2009 through to 2000, there was a half-hearted attempt to raise them in 2018 by Jerome Powell, in which he pivoted, by the way. But up and basically from 2009 until last year, we have had rates low, what's called zero lower bound. So 0 to 0.25%, 0 to 0.5%. And so good quality companies, both small businesses and larger businesses, not only were able to borrow money at low interest rates, but actually took advantage of those low interest rates to term out their debt. And so for larger companies in particular, very, very little debt had to be rolled over in 2022, 2023. Some is in 2024, but you start to see it happening in 25 and 26. So for a company that termed out its debt and has no debt maturing last year, this year, or even next year, the increase in interest rates to some extent is academic. It might affect their customers, but it's not affecting the business. Mm-hmm. And so yes, that's created a much longer runway, before these effects on the market, these effects on the economy become really apparent. That's why I think we're probably going to have a long, if not particularly deep, but a long recession.
Which is, along the same lines of thinking of how much the Fed needs to pay on their interest on their debt as well, right? Just because with every 100 basis point rise or 1% rise in interest rates, it's something like $300 billion worth of interest payments. That's the, let's say, commensurate math on that. That doesn't mean that all of those maturities roll over at the same time, right?
Of course not. But yeah, right now, about half of the federal government's total debt, a little over half, just a little over half, has actually rolled over since interest rates started going up. Now, some of that rolled over last April, right? Some of it when interest rates were, 0.5%. Some of it rolled over, last month. But about half of it has rolled over. That means another half of it still has to roll over. Now, that half may be 30-year bonds issued 29 years ago that are coming due soon. It may be 2-year bills, 2-year notes that were issued maybe at 0.5% or 1% 2 years ago. But you're going from very low rates to 5%. And you're doing that immediately. You're not doing it slowly. And so I absolutely agree with you. We've seen a huge increase, as you just mentioned, but we've seen a huge increase in the amount of debt service that the U.S. government has to pay. but we've only just started. The average yield on all of the federal government bond debt is still under 3%. So that's a big increase to where we are. And I'll say one thing, if I may, Tom. You didn't ask me this, but I'll say it because it's one of my pet peeves. When interest rates were zero lower bound, and when they were actually negative in Europe and in Japan, why on earth didn't the US government issue 50-year and 100-year bonds? You know, the US was the strongest economy in the world. As I say, more than half of the debt in the world was at negative interest rates. Austria issued 100-year bonds. Argentina, for goodness sake, no offense to the Argentinians listening, issued 50-year bonds. Why on earth didn't the US government do that? They could have issued 50-year bonds at 2%, but they didn't. Instead, and this is under both administrations, instead they shortened maturities and started issuing more bills instead of bonds, which was the most foolish decision they could have made. You know, corporations didn't do that. Corporations termed out their debt. Yes, you pay a little more for a 30-year than you do for a 1 year, but you're locking in those rates.
But inflation will take care of that.
Well, we can just print the money. It's not a problem.
Well, Adrian, is there a difference, you know, in the way the market might perceive that, whether that comes as a sign of weakness that you're financing your debt and trying to place it that far out on the yield curve, or if there's an attractive enough interest rate, does that end up kind of tipping the scales in the other direction?
Sorry, I'm not sure I quite understand.
I'm wondering if there's a difference there. The reasoning that they didn't put, let's say, 50 and 100-year bonds out on the yield curve, is there a difference in, let's say, the confidence that presents to the market?
Well, I think when you issue a 50-year bond, it shows that you are confident. I mean, to me, it was a sign of the times that Italy could issue 50-year bonds at 7%. Again, Argentina issued 50-year bonds at like 7.5% or 8%. So if those countries could do it, surely the US could have done it. And you know, strong companies did it. Nestle issued 50-year bonds. A lot of strong companies did it. I mean, typically it's a sign of strength when you can issue a 50-year bond and the market buys it.
Well, and that's why I'm trying to, let's say, resolve this disparity, because again, you brought up the Argentinians, and you know, a lot of our listeners would understand how weak the Argentinian peso is, and if they're putting 50-year bonds out, what does that signal to the rest of the market if the US starts doing the same thing?
Well, I think people would look at the US differently, frankly. No, I mean, I can't answer why they didn't do it. From a treasury management point of view, it just made absolute sense. And even today, frankly, Tom, why not issue 30-year bonds at 4.3 instead of 1-year bills at 5%?
Yeah, that's a great point.
I mean, it signals perhaps that they, whoever they is, the Treasury, think that rates are going to come down again.
Yeah, absolutely. Adrian, do you see a risk for enough appetite for US Treasuries as the US goes back to the market to finance its spending needs, you know, for the rest of this year after the debt ceiling has been resolved?
No, I mean, you raise a good question. And again, 2 years ago, 5 years ago was a totally different issue. The US could have sold as many treasuries as they wanted. But you're right. Now, most of the large buyers of treasuries are no longer in the market. The Federal Reserve is the largest buyer of treasuries, which is a whole different subject, and just shows you what kind of Alice in Wonderland world we're in, where the largest buyer of treasuries is effectively another arm of the government, which is creating the money to buy those treasuries. But anyway, so the Federal Reserve says they're not buying treasuries anymore. China is not buying treasuries anymore. They're trying to reduce them. Russia is not buying treasuries anymore. Japan, as they've started to increase their interest rates to only negative 0.5%, whoa, what a bargain. As they continue to raise their interest rates, even to any kind of positive yield, the money that insurance companies and pension funds in Japan put overseas over the last 20 years will start to come back, So Japan is no longer buying treasuries. So the foreign countries that are the largest buyers are not buying, the Fed is not buying, and the US banks are not buying. So they'll buy the short term, but they're not buying the long term. Maybe that's why the government's issuing it short term. So rates, yes, there's a lot of pressure on rates to move up in the market because of the lack of buyers, frankly. And I don't see that changing in the near future. There are short-term reasons why these people are not buying, but there's also longer-term fundamental reasons, particularly why foreign governments are not buying treasuries. As we know, the weaponization of the dollar. Very few foreign countries are going to be wanting to add to their dollar positions at this time, and they're more likely to want to reduce those dollar positions over time. So, yeah, rates are going to have to move up in the market.
Adrian, as we're talking about this difference in maturities, this difference in durations, obviously that was pointed to as a big, causation of the bank failures that we saw earlier this year in March. So do you think that March was just a primer for what we might see for other bank failures that have the same type of problem yet? Or have banks really had enough time to learn the lessons from SVB and the others, and combined that with the BTFP, are able to avoid the same outcomes?
Yeah, the former. And not just the banks, but I think insurance companies, a lot of insurance companies are at risk. Maybe even some pension funds are at risk. Remember, both insurance companies and pension funds have targets of yields that they must get in order to meet their obligations, right? They must get. And if rates on longer term bonds are only half what they need, they have to take risks. They either leverage those bonds, which in a period of rising interest rates is not a good idea, or they go to more risky assets, right? We saw this in Britain a year ago when, the pension funds blew out, some of them. So again, it gets back to what we said at the beginning about the patience of investors. Investors always expecting things to happen much sooner than they do. We forget that in 2007, we had, Countrywide mortgage. Remember Countrywide? They went bust in, and someone will correct me, but I think it was like September, October of 2007. And there was another big mortgage company that went bankrupt in 2007. Then after that, everybody said, it's contained. A month or two went by with no problem, and everybody said, it's contained. Ben Bernanke, the Fed chairman, said, this is just a problem for subprime. It's not a problem for mortgages. And then 6 months later, or 9 months later, we had Bear Stearns. People forget Bear Stearns mutual funds, or funds, they blew up in 2007. It was 6 or 7 months after that before Bear Stearns blew up. Then we wait another 4, 5 months before Lehman Brothers and AIG. And so the fact that we've had no bank failure or no bank blow up since March does not make me think that the financial problems are over. You know for a fact that those 3 banks were not the only banks or financial institutions mismatching their obligations and their liabilities, their assets and liabilities. Mm-hmm. And as with all people, we skate on the edge, and we fall over one at a time. Warren Buffett has that great saying about only when the tide goes out do you see who's been swimming naked.
Right.
And as rates stay up, and this is a critical thing, it's not how much higher rates go, it's how much longer they stay at these levels. As they stay at these levels higher for longer, then more and more companies that are on the edge topple over. So no, I don't think we've seen the end of distress in the financial industry by any means. And of course, after the three US banks, we had UBS, Credit Suisse,
Right.
which was a huge one. Yeah.
Adrian, you mentioned gilt yields, and I saw this morning that they are the highest now since Liz Truss was actually in office when the crisis kind of hit there. I was reading that over the past year, you were lightening exposure to global positions. So what sectors does that cover? And is that exactly kind of the reason that you ended up doing that, because of anticipating this type of situation?
Yeah, I think that's true. A slowing economy and tightening monetary conditions, and high valuations mean I wanted to reduce exposure to global stocks. Now, I said I'm not expecting a market crash, but that doesn't mean we might not see the entire S&P or Financial Times or FTSE or other indexes down 20%. So if we're going to see a 20% erosion, we want to have cash in order to take advantage of those opportunities. So, I'm reducing most things. I think it will be easier to say what I'm not reducing. There's still some global blue chips that we own, things like Nestle, which is, just a really super solid company. It's increased its earnings and its dividend every year for the last 40 years, except once when the dividend stayed flat. Super company, very defensive, strong balance sheet. Now, if we have a market decline, certainly a market crash, Nestle will come down.
Yep.
But I'm not wanting to go 100% to cash. So it's a matter of what do you keep that has a better chance of holding up, and if it declines, will bounce back sooner. That's another consideration. And the third consideration will be the pays of dividend. So we're holding on to some global blue chips such as Nestle. I still like the business development companies in the US. These are companies that lend money to small businesses. A lot of people think that's a very high risk business in a slowing economy. But again, if you look historically, the business development companies, the better ones, have been able to hold up during periods of recession. Now, people will say to me, and people know the industry, they'll say, what about 2008? 2008, the industry was hurt because there was a credit crisis. It wasn't a recession that hurt them, it was a credit crisis. And just to give an example of that, one company, one BDC that we own and we follow, they had their line of credit. They had a line of credit with one bank, Deutsche Bank, and it was yanked with 7 days' notice. They were forced to sell Treasury bills at a loss. So that's just an extreme case, but that's what happened in 2008. It wasn't a recession that hurt them. A company like Ares, for example, the largest and I think the most conservative of the BDCs, has a super strong balance sheet. They have 3 quarters worth of dividends in arrears. So they're well able to help any portfolio companies that get into trouble, as they did in 2008, 2020. I think 2020, the economy was locked down. So a lot of businesses weren't even open. Smaller businesses weren't even open. And yet during that whole year, they continue to earn money, continue to pay the dividend. So anyway, I like the business development companies, and the dividends on those tend to be high. Beyond that, we're looking primarily at gold and some of the commodities. Gold would be my number one choice because it's the asset, the commodity that is not so vulnerable to a global economic slowdown. If we have a global economic slowdown, that is going to hurt the demand for, let's say, copper, which is one of my favorite long-term stories. It's going to hurt the demand for copper, notwithstanding, electrification and electric vehicles and everything else. So gold, however, is relatively immune to a global economic slowdown. So I like gold stocks. I like some of the commodities. Certainly, we're buying the commodities, on dips. I'm just being a little more short-term oriented, taking profits when we get little runs. And then the last thing and the only other thing we're doing really is we're selling puts on things. Puts in this kind of environment, puts can be, when you sell a put, a below market put, the premiums can be very, very attractive. You have to pick your spots. You'll go for a month or two with nothing, and then you'll have a period when you see a lot. But we've sold puts recently, not just on the gold and gold and other commodity stocks, but we've sold puts on some of the BTCs. We've sold puts on things like MMM, 3M. Anytime you see a stock, a good quality stock, that has a sharp decline for some reason or another, you look at the puts and you can sometimes get 5% for 2 months, which is for under the market puts. You have to pay attention to it, of course, because you want to make sure you don't get all of these things put to you at once. Mm-hmm. But when we sell puts, we always set the money aside for the exercise of the put. Right. But yeah, you can get 5 to 10% on 2 month puts.
Adrian, one of the first times, or one of the last times I had you on the show, we were discussing the Basel III regulations and what an impact that was going to have on, let's say, the gold market. Of course, it does remind me a lot of the BRICS summit that was held at the end of August here. Going into it, it was talked about like it was going to be this big game changer for gold. So how do you see, let's say, the attractiveness and the rise of that alternative trading currency going forward and as a threat to the US dollar?
Well, that's a huge question. Yeah, again, if I may, this goes back to what we were saying, the theme at the beginning of this, but investors always expect the inevitable to happen sooner than it does. There is no question in my mind that from the long view of history, the US dollar and the US, the US and the currency are losing their dominance. Now, these things can happen. The change from one currency being the dominant world currency, the global reserve currency, to another currency, they can happen quickly, or they can happen relatively slowly. We saw when the Dutch, believe it or not, used to be the dominant power, and they lost that very quickly. The French, it took 1815, and defeated Napoleon, and they lost it. So that happened quickly. In the case of, say, Britain, the last transfer from the British pound to the US dollar, that was, again, from a long-term historical point of view, that was pretty quick. But really, the prime period for the pound was 1914, on the eve of the First World War. And it wasn't really until 1945 that you could clearly say, well, now the US was not only the world's dominant economic, political, and military power, but the US dollar was now the world's reserve currency. So that was a period of 30 years. So we should not expect the US to be replaced as the world's dominant trading currency, dominant trading and reserve currency in a couple of months. It's just not going to happen. But at the same time, there's no question in my mind that it is happening. The US, in my view, from the long view of history, is at its peak. It's at its peak militarily, politically, and economically. That doesn't mean it's going to collapse like Rome. It doesn't even mean it's going to have a horrible period like Britain in the post-war period. But it's going to be replaced over the next 20, 30, 40, maybe 50 years. So I think there was a lot of naive optimism about the BRIC currency and the conference in South Africa. I'll say a couple of other things, if I may. Remember, the countries that are joining the BRICS, and there's a lot of countries that want to join, don't have an awful lot in common other than their distrust or dislike of the US. But they don't really have an awful lot in common at the moment. So it's going to be a very ad hoc, I think, a series of ad hoc relationships rather than a very strong formal bloc to challenge the US. The other thing that's important to realize is when we talk about the dollar, we must differentiate between the dollar as a primary trading currency and the dollar as a primary reserve currency. And if you look at the dollar and the reserves, that's been a long slide. 30 years ago, the dollar represented almost 80% of all central banks' foreign currency reserves. And that's now down to barely 50%. That is a huge decline in something that typically moves very, very slowly. Central banks are not traders or speculators. They move very, very slowly. So to go from 80%, I think 30 years ago it was like 75%, to now 50%, is a very, very significant move in a relatively short period of time. I think that's going to continue. It's going to continue because of, the weaponization of the dollar. You don't have to be Russia or even China or North Korea to not want to be too exposed to the US dollar at the moment. Mm-hmm. Remember the US government sanctioned Bank Paribas in France. They sanctioned Banco Santander in Spain. And what was Banco Santander's crime? Their crime was they made a loan to a Spanish construction company that built a hotel in Cuba, not against Spanish law, not against EU law, and yet the US, because they had the power to do it, because the money went through the SWIFT system, thought it was their right to sanction a foreign government, a foreign country, a foreign bank, doing something perfectly legal under their own laws. So anyway, that's one side. The trading side, I think we're going to start, well, we already are. We're seeing a series of ad hoc things, most of them relatively small at the moment, but the big one, of course, is China and Saudi Arabia. So Saudi Arabia selling oil to China using yuan instead of the dollar. That's the big one. Now, in terms of trade, most trade is still in the dollar. Most trade around the world still takes place in the dollar. But these things tend to have a momentum of their own. They start very, very slowly until they reach some kind of critical mass, and then they start to build much more rapidly. So I think that's where we are at the moment. At the moment, most trade still takes place in the dollar. Mm-hmm. But I think people who think that the dollar will remain the world's dominant currency forever. I heard someone the other day saying on an interview, it will be the world's dominant currency forever. Now, they probably misspoke, but that is a ludicrous thing to say. So that's going to start slowly, as Hemingway said. How do you go bankrupt? Slowly at first, and then suddenly.
Yeah.
And that's what's going to happen with the world's reserve currency, I think. In 1815, after the defeat of Napoleon, it was very, very obvious that Britain was the world's dominant political and military power, but France was defeated. The changeover was obvious. In 1914 and 1945, it was very, very obvious that Britain was no longer the world's leading military power, but the US had taken over. The US incidentally extracted a very high price in terms of the land lease arrangements for the aid during the Second World War, which some people seem to forget, a very high price. But it was number one, it was pretty obvious that the US was going to take over from Britain. And the other thing that's really critical to understand is that although some British people may have been, shall we say, upset, the loss of power, resentful of America, whatever, generally speaking, we were on the same side, right? I mean, America had supported Britain during the war. And so that handover was a peaceful one. It was inevitable and it was peaceful. When you look at the situation today, we might say, well, China's obviously the next global superpower. But America, absolutely, the powers that be in America, absolutely do not want China to take over. Even if they think that China is gaining in military power, they absolutely do not want to be replaced by China. And so we may see some kind of, that's a broader subject, but that may be some kind of conflict before it happens. Obviously, when Britain relinquished the reins to the US, it was peaceful, and it was a lot easier to do than when you're handing over to someone who's your enemy, or I'll use enemy in quotes, but people in US, people in Washington refer to China as the enemy, which is the most preposterous thing to do imaginable. Anyway, enough on that. Sorry.
I would tend to agree, Adrian, but what does all of this mean for the gold price? When we look at let's say the balance of what investors typically look at for drivers of the gold price, it seems that most would expect the price to be higher. So what is really driving the gold price here?
Yeah, no, that's a good question. And, gold investors, in my experience, always want more. They are never satisfied. They're never satisfied. Look, a year ago, gold was just barely over 1,600. A year ago, today, 1,620. We're now almost at 1,900. So that's a pretty darn good return in 1 year in the face of the most aggressive tightening that we have ever seen by the Federal Reserve, the most aggressive pace of tightening that we've ever seen by the Federal Reserve, and tightening around the world. And not just tightening that has taken place, but the prospects for future tightening remain in the US and around the world. So in the face of that, gold to go up from 1,600 to 1,900, I think is pretty powerful, But again, gold investors never seem to be satisfied. Now, I think what has happened in the last, few months is you've had the Federal Reserve continue to tighten more than most people in the gold market particularly thought. Remember 6 months ago, all the talk was about a pause and a pivot and everything else. But instead, and the gold market believed that more than the stock market even, but the Fed has continued to tighten. They may tighten again, another rate hike this year. I think that's likely. I've said that, for the last few months. I think we're going to see another rate hike this month. And then again, let's not forget, as Peter Buchbar keeps reminding us, higher for longer, even if they don't increase rates, but higher for longer is its own form of tightening. So not only have we had these dramatic increases, and they've gone on longer than the gold market was expecting, But the Fed is trying to tell us, trying to convince us that they're going to remain higher for longer. That's true also in other countries around the world. As I mentioned earlier, even Japan is raising rates. So you've got that hiking situation around the world. That's number one. And the number two is when you had in the US, you had the lockdown, the situation over the government debt ceiling. And during those negotiations, during that period before the debt ceiling was increased, the Treasury was prevented from issuing any new bills or bonds. So since June, we've had a backlog of Treasury issuances all coming in. So for the second half of this year, right, we've had a lot more issuance than we would normally have in that period of time. We probably still have another $2 trillion to be issued. So you've got excess Treasury issuance, which means high interest rates on short-term bills, plus a tightening environment, and that is negative for gold. I think that's going to change. It's probably going to change, early next year when the economy in the US and other countries, UK is a good example of a weakening economy, also all of Europe. But when the US when it's clear that the US is in a recession, and the Fed is looking at a situation where inflation is not killed, has not been squashed, where the economy is slower, the interest rate service of the debt on the US federal government is going up to unmanageable levels. And you've got an election coming. So early in the next year, the Fed is going to have to stop raising rates and probably cut rates, but they'll have to reduce rates or use some other form of stimulus before inflation is killed. And when you look at the inflation numbers, let's not forget oil prices shot up in the last couple of months. It's over 90 as we're speaking, the oil price. And of course, that has an immediate impact on gasoline and on transportation. Gasoline and transportation, an immediate impact, but it also has a longer term impact, a delayed impact on pretty much everything that we buy. Everything in the stores is shipped to where it's going. And so as the oil price has moved up, and if it stays anywhere near where it is now, we're going to see the price of all goods in the stores start to move up again. And again, that's going to have an impact on the CPI. So I think we're going to see the CPI start to move back up towards the end of the year and into next year. We're going to see the economy slowing, and the Fed will really, at that point, being a big dilemma. And that will be very positive for gold.
Adrian, how does central bank buying of gold factor into this equation as well here? The last year has seen record buying, and it would almost seem that in order to accumulate the metal, they wouldn't want a higher price until they've reached their, let's say, the goal that they have for a quantity. Is that part of the calculus that we need to be considering here?
Well, I think it's very important. What you say is very important. That the central banks have been the main supporter. Central bank buying has been the main supporter of the gold price over the last 12 months, really, since last October. If you look at ETFs, for example, gold ETFs, they've had outflows. Other than a couple of months at the beginning of this year, they've had ongoing and fairly significant outflows all year. So gold has been supported primarily by the central banks. The central banks tend to be price insensitive. When they make a decision to allocate 5% or 10% of their reserves to gold, they're looking at that not as a trade, but as a long-term position. And so they tend to be relatively price sensitive. Now, having said that, one of the big concerns that I've expressed is that when you have, for example, when you have very strong demand for 1 ounce gold coins from around the world, you've got millions and millions of people buying those coins. When you have ETF inflows, you've got, again, millions of people buying ETFs. When you're looking at the central banks over the last 12 months, the vast majority of the buying has been, a handful of banks, 4 or 5 banks. So you only need 4 or 5 banks to decide to pause their buying for a short period of time for it to have a meaningful impact on the gold price. You don't need millions of people to change their mind. You just need a handful of people to change their mind. And I think that's one of the big risks in gold that remains. But I mean, fundamentally, on a longer term basis, I think that the central banks are going to continue accumulating gold for the same reason. They're reducing their exposure to the dollar, and they want a global asset.
Interestingly, along the same lines of, let's say, people changing their minds here, do you think that gold and gold mining investors are suffering from market fatigue here, as the anticipation of all these previous issues that we've touched on have not really had the effect that they're anticipating? This goes back to your point that it's probably a good lesson to trade the market that is and not the market that you expect or want to evolve imminently, right?
No, I think that's absolutely true. I mean, you go back to January, February, March of 2022, and you had the Russia invasion of Ukraine, and then you had inflation, which, let's not forget, in the US bottomed in August. So we'd already had the whatever that is, 6 or 7 months of increasing inflation levels before the Fed came in. So you had higher inflation, and you had a war in Europe. Everybody thought gold was going to the moon. But again, if you look at history, you find that geopolitical events tend to have very, very, very short-term effects on the price of gold. Very rarely does a geopolitical event have an ongoing boost to the price of gold. Inflation, again, markets are forward-looking, and markets should be forward-looking. And, when inflation starts to move up, you should be saying, what is the Federal Reserve and central bank's reaction to that going to be? Now, the Fed waited far too long to start raising rates. Different issue. They were far too loose for far too long. That's a different issue. But when you see inflation move up for 6 months in a row, as it did from August of 21 to March, April of 2022, you should be thinking, what is the next move? The next move is the Fed is going to start tightening. And when we enter a recession, you should be thinking, what is the next move? The next move is the Fed will have to start easing. But again, there's a bit of a lag in that. So yes, I think gold investors were just expecting far too much. And we didn't see, again, we saw gold move, as I said, from 1,600 to 1,900 over the past 12 months. But somehow that's not enough for gold investors. And then the other thing is we saw gold move up, but the gold stocks not respond. And so that's just something that builds on itself. People get disenchanted. I would describe the sentiment for gold stocks at the moment as probably as weak as I've ever seen it. But other than gold investors, dedicated gold investors, whether it's a gold mutual fund or whether it's a gold bug, and I'm a gold bug, I wear that proudly, no one is interested in gold. It's not a matter that people are saying, I think I'll wait for this or maybe then or whatever. They're just not interested. It's just not on their radar. And the gold investors can only do so much. We're a dwindling band.
Well, sentiment was actually something I wanted to talk to you about because you were recently at the Denver Gold Show where, I heard several reports and saw some pictures that it was like absolutely dead. Of course, you were at Beaver Creek as well. So what do you feel that the actual sentiment is like from a real feet on the ground type perspective.
Sure. Well, I saw some of those photos too, and I think they were taken at 5 or 6 in the morning. It wasn't that bad. I think they were making a point. So, let's look at the two conferences. They have these two conferences every September, back to back. They're both in Colorado. One's in Beaver Creek, which is primarily for the junior and the exploration companies. And then the other one is the following week, which is in Colorado Springs, which is for the senior and producing companies primarily. So you get different companies. You also get a different set of investors by and large. So my broad take would be that Beaver Creek, which is juniors, they had record attendance. I mean, attendance was up, even higher than pre-COVID. In terms of investors and in terms of companies, I heard that they had a waiting list of 70 companies wanting to attend that they just couldn't take. So that was certainly well attended.
Maybe that's more indicative of the amount of companies that are still trying to raise money in this market.
Yes, you beat me to it. You're quicker than I am. It was astonishing to me how many companies were trying to raise money now. And I've got a hint for if anyone wants to hire me as an advisor, I'll advise them to raise money in August ahead of the rush. I think I had at least 8 companies that I met with that were raising money now or next month. And Tom, I'd already pre-selected the companies. I was speaking to the companies that I like, which typically are companies with stronger balance sheets. So yeah, a lot of companies raising money. The attitude among the companies was, I would say, reasonably down because there wasn't a lot of money available from investors. Mutual funds are having redemptions. There wasn't a lot of money available for them. But the bright spot was that a lot of the senior companies sent their technical teams up to, and their business development teams. And so they were getting, those junior companies, explorers, were getting a lot of meetings from senior companies looking at the projects that they have. Now, as we know in the past, that takes time before that translates into any kind of meaningful deals. And not every company that had a meeting with a Newman or Barrick is going to do a deal, of course not. But that was one thing that was interesting there. When you go to Colorado Springs, the Denver Gold Forum, and the larger companies, attendance was down. I mean, it was up on last year, perhaps, but it was certainly down from pre-COVID levels. No question. No question. Just anecdotally. The mood among investors was not particularly positive, I would say. But the mood among the companies, most of the companies, were very upbeat. And for good reason. Most of the companies have strong balance sheets. The XAU is now cash positive on the balance sheet, the whole industry. So most people have strong balance sheets. A lot of them have good cash. A lot of them will have, a good project pipeline. Most of the companies, notwithstanding the cost overruns and the delays we've had in building new projects, but most companies are sort of on track with their production, on track with their guidance, on track with their new developments. And so the companies were, for the most part, quite upbeat, which was a contrast. So at Beaver Creek, you had the companies depressed, but the investors kind of interested for bargains. And at Beaver Creek, you had investors, fewer of them, not overly interested because they didn't have a lot of money, but the companies quite upbeat, notwithstanding the stock prices. And, one other thing we were talking before, one of the big things everyone was talking about, and everyone's been talking about for months, is this huge dichotomy between the gold price and the gold stock price. And, everybody just assumes that you close the gap by the gold stocks moving up. There's 2 ways you can close the gap, of course. The gold price can come down.
That's
and we've
just
seen that.
the less palatable version, right?
Yes, and we've seen that in the last few months. But the truth is, the gold stocks, certainly the producers, are trading at some of the best valuations that they've traded at in decades. Certainly on cash flow basis. And so the gold stocks, I think, are remarkably inexpensive right now. If gold goes from 1900, it won't go back to 16, I don't think. But if gold goes from 19 to 18, that's going to see further declines in the gold stock prices. But I think we're getting very, very close to a bottom in the gold stocks.
Mm-hmm. So just to kind of summarize, you're seeing a situation that's, overall very positive, between, let's say, the macro setup here and what follows next, and then from, let's say, the large producer trying to or showing interest in exploration plays to replace those ounces that they need, right?
Yeah, I think that's absolutely true. So, most of this year I've been saying that I think gold, although I've admittedly been saying the gold stocks are very cheap, no question there, but I've been saying that I think it's going to be, well into the end of this year or beginning of next year before we really see gold move up significantly. And that's because people will buy gold when they believe or sense that the Federal Reserve has lost control of inflation. So 6 months ago, 4 months ago, 3 months ago, there wasn't that sense. The Fed was still increasing interest rates, and inflation numbers, CPI numbers, PCE numbers were coming down. But when we start to see inflation numbers move back up again, and the Fed really unable because of the slowing economy and the rising debt service of the federal government, unable to increase rates, that's when gold will turn. So to say that again more succinctly, when investors think the Fed is unable to control inflation, that's when gold will up. And again, let's look back at the 1970s. Everybody talks about, Jerome Powell doesn't want to be another Arthur Burns, he wants to be a Volcker. Let's not forget that after the mid-70s recession, Arthur Burns was raising interest rates every single quarter. Every quarter, he was raising interest rates along with inflation moving up, but he was raising interest rates. But investors felt, for whatever reason, and they were right, but they felt he was not going to take the steps necessary to actually kill inflation. And that's why gold continued to move up in the 70s. It was only when Volcker came in and doubled interest rates, basically. Interest rates Fed funds rate was already double digits when Volcker came in, forget that. But he took it up to 20%, almost doubled it. And people believed he will kill inflation and gold price get down. So right now, people are still believing Powell. I think, sometime in early next year, it'll be clear that he's lost control.
Yeah, I think to set up, as you laid it out, these are going to be the things that line up next, right? It's not there's not an infinite amount of choices for what happens next. So it'll be very, there's only so many paths that we're going to really see from here. So I think it's just a waiting game at this point.
No, absolutely. I agree with you.
Yeah. Excellent, Adrian. Well, I think that's a good place to wrap up our conversation for today. Is there anything you want to add before we do?
Well, just hope you get over that horrible cold you've got soon.
Just bad allergies. I apologize.
Oh, allergies. Oh, I feel sorry for you. Okay.
Well, it could be worse. Of course, more information from you is all available at adrianday.com, correct?
Well, the best way would be adriandayassetmanagement.com. Yeah.
Excellent, Adrian. Thanks so much for your time today and look forward to speaking with you in the future.
Thank you very much, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.